So here's another one I think is going to be one where it's a bit more situational because we're asking it for specifics. And when you ask for specifics, it can be where ChatGPT nails it or where it fails it. And we asked it, again, in the voice of a financial advisor, what are effective strategies for diversifying a portfolio? So I think you'll like this one.
Yeah.
This is right up your alley.
Yeah.
So it says the effective strategies for diversifying a portfolio are asset allocation, geographic diversification, sector diversification, time diversification, and alternative investments. So what are your thoughts on that?
It's good.
Okay.
It covers the vast majority of what we talk about with folks in regards to where we want to position funds. When I say funds, what I mean is your money. Now, there are different kinds of investments that aren't mentioned in here, which would be more specific. What am I actually holding in my portfolio? Stocks, individual bonds. Are they mutual funds? Are they ETFs? Are they limited partnerships, REITs, all these different kinds of strategies? Am I just literally holding on to gold and burying it in my backyard? Is that a diversification strategy, I guess?
Would that be considered a diversification strategy?
No, it's
No?
not. But I think this, the word diversification, especially in a year like we just had in the stock market where most people were down, unless you buried a bunch of gold in your backyard. And even then, I don't even know if you were successful.
Right.
It's one of those things where it's more and more common to not understand where you were, because the past decade plus, really since the Great Recession, it's been pretty easy to make money. It's not consistent every year, but for most folks, you're
talking about the
money.
2008 one specifically?
Yeah. So if we go through that, back then, if you had everything undiversified, let's say in the S&P 500 index, so tracking 500 biggest publicly traded companies in the United States, it took you a couple of years maybe to remake everything that you lost in the Great Recession. So maybe let's call it 2011. You're back in black, so to speak, like you are today.
I try.
But, from that standpoint, was that a healthy diversification? Going through that experience, most people thought, oh, shoot, maybe this isn't the level of risk I should be at. Maybe I should diversify. So having something like ChatGPT put out here is helpful because it at least gives you some guidelines to consider. I think, again, in the nuance is where you're going to find greater success in terms of the kinds of things that you want to hold. Because, one thing that I noticed it didn't mention immediately was tax diversification. So going back to like what we talked about before about taxes, it is a very essential part of your plan to have certain kinds of investments represented across your portfolio. So, do you want to hold on to a mutual fund, which is going to spit out capital gains, which if you're not familiar, all you need to know is that you're going to get a tax form and they're going to distribute any kind of gains. So if you have a banner year in your mutual fund, you're going to pay the taxes on that growth for probably all of the growth in that year. Now, is that the appropriate thing to have in that kind of portfolio? Or should we be holding on to our individual stocks there? If I'm thinking about, if I'm a young investor and I'm trying to get off the ground and I'm maybe focused on Roth investments, but I've got this pre-tax account from my employer and that's where their match is going, I want to be aggressive in my Roth rather than my pre-tax account. Do you know why, Dave?
No, tell me.
Because in the Roth account,
I'm fascinated with this.
We are incentivized. We are incentivized to be aggressive in our accounts where we have tax-free income in the future. Well, if you're not following along, if you have a Roth option in your 401k or you've got a Roth IRA, in that account, we have the ability to invest, provided we have it for 5 years. We're 59 and a half years old or older. When we get it, we don't pay any taxes on the earnings. So if we're going to be aggressive someplace, let's be aggressive in the account where we potentially don't owe any taxes on it.
Well, it's interesting too, because out of the 5 that it mentioned, like you said, that's not one of the things. It talked about assets, geographic, sector, time, and alternative, but it didn't really mention anything in terms of the delaying, so to speak, of the tax payments, which is what you're talking about.
Right, yeah.
So it's like if we earn X amount on this thing, there's ways to, to where you don't have to pay all of those capital gains right away.
Yeah, and like in the alternate investment space, which really, and I'm kind of surprised because you just told me that this might be 2021 data that they're grabbing from. 2022 is a year where alternatives saw a greater influx of, or I should say inflows of money to those kinds of investments.
And is that because you saw such a disruption in the S&P 500? that more people wanted to look at alternative sources just versus the top 500?
Yeah. So 2022, if you had stocks and bonds, let's say mutual funds in your portfolio, probably both of them fell last year. It's a rarity that both stocks and bonds fall at the same time. Normally they're negatively correlated. So
before we get too far ahead and people's eyes start glazing over, because you're using a lot of big terms, explain what negative correlation is.
Yeah. So negative correlation is basically when one thing goes up, the other one goes down. Okay. Positive means they both react the same way. No correlation means anything could happen. So alternative investments. So the reason I was talking about this is because alternative investments don't normally, for most purposes, have a correlation to stocks or bonds. And so in a year like 2022, where we saw stocks and bonds are down, you're trying to find something else that might be entertaining. That could be a real estate investment trust, otherwise known as a REIT. It could be a limited partnership, which could be defined as pretty much any kind of business opportunity that you can invest in.
Gotcha.
So there's lots of things that people were looking for. And again, that's a part of this. So again, kudos to ChatGPT for even mentioning it as an option, because it's not generally something that I think an advisor is going to lean on as something that we should be considering. Thankfully, we have. In our office at least. But
it might have been one of the reasons why it listed last. Number 5 out of the other 4.
That could be true.
And do you feel like in terms of the order that it listed them, that it's accurate in terms of like what your office or another financial advisor would focus on, meaning assets probably first, geographic second, a sector, then time, then alternative?
I think so, because asset allocation being number 1 is the tried and true method of how most advisors are going to describe diversification in the first place, which is they're defining it as diversify your portfolio by investing in a mix of different asset classes such as stocks, bonds, and real estate. So if you look at your 401k plan, that's the kind of stuff that's already in there. So that for some people accomplishes the diversification they're looking at.
And where I guess number 2 through 5, geographic sector, time, and alternative, that's more so if you've got number 1 pretty much locked down, you know what you're getting from that. It's like, okay, now I want to make lots more money. Or like you had said, diversify into a bunch of different areas.
I'd probably put it that we might say within the large cap space. So large U.S. companies, when I say large cap, it might mean, okay, within large cap, that could be any big company that exists.
So would this be like
it could be Google? It could be
that's
anybody.
what I was going to say. So like
now we're getting into
tech,
sectors.
Like, okay.
Yeah, so that's where sectors come into play. So it's sub-classifications within the asset allocation.
So give me an example. If a primary target would be like Google, what would be like a sub to you?
Yeah, a technology.
Just technology in general.
Technology, communication.
Okay.
That kind of, I mean, what doesn't Google touch at this point? That they couldn't be considered
everything
in every sector.
Yeah.
Yeah.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.